Have you ever stood at a crossroads, where the path ahead is thrilling but shrouded in fog? Where a golden opportunity seems to gleam, but a quiet voice inside whispers a warning? That's where many of us stand today, looking at the meteoric rise of AI stocks. It feels like the dawn of a new era, a revolution that promises to change everything. But as we chase this brilliant light, are we running towards a sunrise or a siren's call, leading us towards the treacherous rocks of a bubble? This isn't just about numbers on a screen. It's about our dreams, our savings, and the future we're trying to build for our families. It's a journey that requires not just courage, but wisdom. The first tremor, the first sign that the ground beneath our feet might not be as solid as it seems, is in the numbers themselves, valuations that have detached from reality and soared into the stratosphere. We see this in the almost unbelievable PE ratios. A healthy company might trade at 20 or 30 times its earnings, but we've witnessed AI-related stocks like Palantir at one point. With forward PE ratios climbing past 200, this isn't just optimism. It's a bet on a flawless, infinitely prosperous future. A future where growth never slows and competition never arrives. The stock prices are no longer tethered to the profits and cash flows of today, or even the reasonable expectations of tomorrow. Instead, they are fueled by a narrative of infinite growth. A story so compelling that the widening gap between the dream and the reality of improving returns is simply ignored. This story is amplified by the colossal market caps of a few mega companies. We watch in awe as giants like Nvidia cross unimaginable milestones, reaching $3 and then even $4 trillion in valuation. But it feels like we are witnessing history. But it's the kind of history that often comes with a painful lesson about gravity. What goes up, especially that fast, must eventually come down. This financial vertigo is amplified by the powerful, invisible force of crowd psychology. It's a feeling that sweeps through the market like a fever, a collective belief that this time it's truly different. We hear the whispers turning into a roar. You can't lose with AI. This is the next internet. Get in now or be left behind. This isn't just investment advice. It's a form of irrational faith, a passionate conviction that the upward trend will continue forever. The fear of missing out, FOMO, becomes a more potent driver than any financial statement or sober analysis. Reason is drowned out by the thunderous applause of the crowd, and we feel an almost primal urge to join in, to be part of the winning team. The classic, dangerous phrase, "This time it's different," echoes through forums, social media, and even mainstream news. It's a justification for valuations that defy all historical precedent. A belief that the new technology has rewritten the fundamental laws of economics. This herd mentality is further automated by the very structure of modern investing. Trillions of dollars in index funds are programmed to buy more of what's already rising, automatically allocating more capital to the biggest AI names without a human hand to pause and question the underlying risk. We are, in a sense, building a machine that feeds the frenzy, creating a self-reinforcing loop that pushes prices ever higher, far beyond the point of reason. Following the trail of money reveals even more unsettling signs. The flow of cash becomes a torrent, but it's not always flowing towards the most deserving businesses. We see a surge of strong speculative money pouring into companies with vague promises and exciting narratives, rather than those with solid fundamentals and a proven track record. The price of these stocks rises not because their intrinsic value has increased, but purely on the expectation that another buyer swept up in the same excitement will be willing to pay an even higher price tomorrow. This is the very definition of a speculative bubble. To amplify their bets, many investors are turning to high leverage, borrowing money to buy into the rally. This makes the entire market incredibly fragile. A small downturn can trigger margin calls, forcing mass selling and turning a small crack into a catastrophic collapse. At the same time, we see the giants of the industry engaged in a massive spending spree on AI infrastructure. They're pouring billions upon billions of dollars into advanced chips and sprawling data centers. While this investment is necessary to build the future of AI, a growing chorus of fund managers is asking a critical question. Will this colossal expenditure ever generate a commensurate return? There's a growing fear that companies are overinvesting, caught in their own competitive frenzy, and that much of this capital may never translate into the phenomenal profits that the stock market has already priced in. Like a canary in a coal mine, other seemingly unrelated assets begin to send out their own warning signals. The extreme volatility of Bitcoin and the broader cryptocurrency market often serves as an early warning light for speculative fever in the tech sector. These assets are the playground of the most risk-tolerant capital. When Bitcoin takes a sharp dive, it can signal that this speculative money is retreating, pulling liquidity out of the riskiest corners of the market, a tide that could soon go out for AI stocks as well. Even within the celebrated AI sector, cracks begin to appear. While the overall market remains euphoric, individual AI stocks may start to show signs of trouble. A slightly disappointing earnings report or a cautious outlook can trigger a sharp, violent price correction, revealing just how fragile the confidence was. These isolated incidents are signs of increasing caution. Moments where investors, for a brief second, pull back the curtain and question the narrative. They are the first raindrops that hint at a coming storm. Perhaps the most direct warnings come from the very people who stand at the heart of the industry, the leaders who have a clearer view than anyone. When the CEOs of behemoths like Alphabet or the heads of major financial institutions like JP Chase and Klarna begin to publicly voice concerns about an AI bubble and the need to reassess valuations, we must listen. These are not outsiders. They're the architects of this new world. Their warnings are not born of ignorance, but of a deep understanding of the technology, the market, and the human psychology driving it. Their cautious words cut through the noise of the hype. Alongside these titans, a growing number of independent analysts from reputable investment banks and financial institutions are consistently raising red flags. Their reports, filled with data and historical comparisons, continuously warn about overvaluation and the escalating risk of a severe market correction. They are the disciplined voices in a sea of emotion, reminding us that fundamentals, in the end, always matter. Navigating this moment is a profound personal challenge. It requires us to find a quiet center within ourselves amidst the roaring crowd. The path forward is not about abandoning the incredible promise of AI, but about engaging with it wisely. We must stay disciplined and data-driven, grounding our decisions in the fundamental analysis of a business, not the fleeting emotions of the market. It means resisting the siren song of FOMO and refusing to use high leverage that could wipe us out. True strength lies in diversification. It's building a balanced portfolio that doesn't bet the entire farm on one single sector, no matter how promising it seems. It means having the courage to minimize risk, perhaps by trimming positions or adding defensive assets when the market shows clear signs of irrational euphoria. Most importantly, this journey requires psychological awareness. We must understand the powerful pull of crowd psychology and recognize its influence on our own thinking. We need to be honest with ourselves about our own fears and desires, and not let them cloud our judgment. Recognizing these signs, the dizzying valuations, the herd mentality, the speculative money flows, and the warnings from those in the know is the first step toward protecting ourselves. It's how we transform from being a passive participant, swept up by the current, to an active navigator of our own financial destiny. This isn't just about spotting a bubble. It's about a journey of growth, of learning to balance hope with wisdom, and of building a future on a foundation of rock, not sand. It's a challenge we must face, not with fear, but with clarity, courage, and the quiet confidence that comes from knowing we are prepared for whatever comes next.